Now let's head out to Brandeis economics professor Catherine Mann. She is a former Federal Reserve economist and served as senior international economist on the first President Bush's Council of Economic Advisors. Catherine, great to have you here with us.
Hi, Carol.
Hi. You know, you heard what Ben Bernanke had to say today in terms of what it's going to take to get back for employment to normalize. You saw the job picture today. What do you think should be kind of our bottom line takeaway from these events?
Well, I think the issue that I have not seen addressed in Bernanke's statements or in his op-ed in the Washington Post is the extent to which the quantitative easing 2 really hasn't filtered down to the small and medium-sized business sector. That is where job creation is going to happen. It's where we haven't seen jobs being created. If you look at the Institute for Supply Management Non-Manufacturing Index, you're not getting any employment out of the services sector. That part of the economy needs to have credit from the banking sector, and they're not getting it. We need a discussion about that.
Hey, Catherine, Matt Miller here. I wonder if you look back in the 82 recession, unemployment continued up even during the recovery to 10%, past 10%, almost 11%. Do you think at the time we were also hearing from people that it was going to take 5 years, 10 years to get back to normal unemployment because we bounced back rather quickly then, even though it looked so dire at the time?
Well, the source of that recession was somewhat different, and so we were able to rebound much more quickly. The size of the employment loss back in the 81-82 or the 91-92 recessions, those were much smaller declines in the number of people put out of work. And so in that sense, the hole is a lot deeper this time around. We also have to think about the characteristics of the workforce being different, the nature of the job requirements being different, people being unwilling or unable to move because of their houses being underwater. Even the existence of the long-term unemployment benefits, although they are very good for many reasons for the individuals who depend on them, they do create some stickiness in the unemployment rate.
Catherine, are you saying, bottom line here, that we need to see some other kind of either government initiatives to kind of get more out of the services sector in terms of creation of jobs, to get more out of those small businesses? Do they need to do something, or do we need to be patient because this cycle perhaps not unlike others or unlike others, and it's just going to take some time here?
Well, I think I wouldn't go for some government initiative. That's not the strategy that I think is appropriate, because you can't make businesses hire their workers. However, we have seen the initiative put forward to reduce the payroll tax by 2 percentage points, and that is going to have an impact on getting workers back into the pipeline, and to work. But one of the things that is important to know is that, as I said, quantitative easing 2 hasn't led to commercial and industrial lending by banks. That continues to roll off, and small and medium-sized businesses are more dependent on lending than is the large component of the economy. In previous recessions, the bully pulpit of the Federal Reserve has been used to greater extent than it has been in this one.
So, Catherine, I mean, Ben Bernanke kind of came out of the gate and he talked a lot about unemployment. Is he sending, though, the right message in kind of doing that and stressing that? He also talked, of course, about the deficit. Those points stressing, are those the right areas for him to be kind of focusing on, in your view?
Well, he was asked about what the mandate of the Federal Reserve was and how monetary policy would be related to that. And, of course, the Federal Reserve has the dual mandate, focusing both on the inflation rate as well as ensuring sustainable growth, which translates in part into unemployment. So one of the things he wanted to say was that at this juncture, with the unemployment rate as high as it is, the economy is not utilizing its resources fully, and so it's not making one of those mandate targets. Not only that, of course, the inflation rate, it's not making that. So 2 for 2 is pretty bad, and that means that the QE2 has some rationale, according to him.
Hey, I wonder, at the beginning of what is now the last decade, we heard from Paul Krugman urging then Fed Chairman Alan Greenspan to keep interest rates low and do some quantitative easing of his own to try and encourage housing inflation. That didn't turn out very well, but Ben Bernanke and the current Fed want to encourage inflation, too. And when we see it in food and commodities, it doesn't really affect anything, since housing costs are obviously really the big part of what we all focus on. Should they be doing that, or do we risk another problematic bubble?
Well, I think there are some issues having to do with the channel of transmission of the large-scale asset purchase program, which of course is the true name for QE2. I think there are some problems with the channels of transmission of that program into the economy. As it was stated extremely clearly in the Washington Post article by Chairman Greenspan, the objective is to reduce interest rates to encourage asset price increases, and that increase in asset prices will engender consumer confidence, business confidence, and that will lead to spending. Now, and that spending, of course, will lead to jobs. Now, that's a little bit different from a channel of transmission of lower interest rates encouraging plant and equipment and other types of spending on equipment and software and adding to the capacity of the economy to grow, and through that channel leading to jobs and spending. So I do think that there's a big emphasis on asset prices in this QE2 program. That's different from kind of a standard mechanism.
Okay, going to leave it on that note. Catherine, thank you so much for finding some time for us. Catherine Mann of Brandeis University.